At some point, the stock market is going to crash, and I am actually looking forward to it. It might be caused by the bursting of the AI bubble wiping trillions of dollars of value from some of the world's largest companies like Nvidia or AMD. Or maybe it starts because the Iran war escalates further, sending oil prices to their highest point in years and choking the global economy. Add in the fact that many countries are facing a brutal cost of living crisis with rising prices, stagnant wages, and slow growth. You have yourself a melting pot ready to pop at any moment. Now, I am fully invested in the stock market, and I have got hundreds of thousands of pounds at stake across all of my different investing accounts. If a crash was to happen tomorrow, let me share with you exactly what I would do, how I would invest, and what I would be thinking while the world panics. But first, let us talk about stock market crashes, because most of you treat them like the end of the world when they are actually just a clearance sale. As I am making this video, there is plenty going on in the world that has people calling for the next stock market crash. Just like I mentioned, we have got many people calling for the AI bubble to burst. Companies are spending hundreds of billions of pounds to build new data centers and buy HYDNIM chips from the likes of Nvidia in the battle to win the AI arms race. These huge expenditures of real cash today have a lot of people worried about whether they will see profits anytime soon or if it is just Itenjobajosajo all over again. Recently, Mark Zuckerberg announced that Meta is investing up to $1 billion on AI projects in the coming year. But there is no sign yet if this will actually make them any more money or just result in more cartoon avatars. Their shares have fallen this year by around 5%, and they are one of the worst performing stocks in the Magnificent Seven. On top of everything around AI, we have obviously still got the war in Iran going on, pushing oil prices into multi-year highs. Oil reserves around the world are approaching their lowest level in years, and there is no sign at the moment that this conflict comes to any simple resolution. One day it is over, and the next day the Strait of Hormuz is closed. Again, these higher prices for oil are hitting some of the poorest people in the world and are causing inflation to remain higher for longer during a cost of living crisis. However, with all of that said, let us just put that to one side for a second and step back. A market crash is something that almost every investor fears, whether you have been doing this for years or you are still sitting on the sidelines with your cash. There seems to always be a voice from some corner of the room that any moment now a crash must be coming. Now, a stock market crash is generally defined as a decline in the market of more than %. Anything less than that, say around % or so, is typically called a pullback or a correction, which is basically just the market taking a breather. Crashes are the most serious stock market event, and throughout history they have happened quite a few times. In fact, if you look back at the market over the past years or so, we see 7 major stock market crashes, but if we add in other declines of more than %, we get to more than 7 different events. This is everything from the Great Depression of the Itenjobajosajo that saw declines of almost %, to the more recent global financial crisis where stocks fell more than 1%. On average, you are looking at cutting stock prices by 5% from peak to trough, and typically they last about a year and a half. The recovery afterwards takes approximately years and now months on average. Now, all of that sounds pretty scary to me, and it is not really surprising that this is how most people feel as well. Nobody wants to invest their hard-earned money and then just see it all disappear in their investing account. It is at this point where most people end up going wrong, and it is not really surprising when you consider the way that we all think. Picture this. Everyone around us says the market is going to crash. They point to all of the data, all of these charts, and they say that a market crash is due any time now. So you better be ready for it, because it is going to be really, really bad. Our normal human response to a situation like this is to go into protection mode and make sure that this crash won't affect us. So following a typical reaction, if a market crash does start to happen and we see a few red days or weeks, we might start to worry. We think that we better get out of our investments as soon as possible before we lose everything. We may as well save what we already have, take the profits if we have any, and hold on to our cash like a security blanket. We might even think about buying things like gold or bonds, with the idea that we will just wait this out and then buy back in once the crash is over. All of that sounds perfectly normal, and it is a rational way to think about things if you are a normal person, but not if you are an investor. Stock crashes are bad, so let us just avoid them and only invest when times are good, right? Oh, how I wish investing was just that easy. But unfortunately, this is not how the market works. If it was as simple as that, we would all be millionaires in a very short space of time. You see, in order for that plan to work, you would have to have some kind of amazing crystal ball and get your timing perfectly right multiple times. Firstly, you would have to know a crash was about to come and sell out just before all of this happened. Then you would need to know how long the crash was going to last for. Is it going to be one that lasts for a couple of years, or will it be the kind that bounces back in just a month? After that, you would have to be certain that the crash was over so that you could buy back in. And in order to do that, you would have to time your new purchase right at the bottom, which is typically when fear from everyone else is right at its highest point. Then after that, you would have to know that the market was going to go up so you could sit there with all of your profits and ride the wave. Let us get this part out of the way. Now, there has been nobody in history who has ever done this on any kind of consistent basis. Sure, there are plenty of times when someone has timed an investment which appears to have been perfect, and there have been people who have successfully called a market crash and even made a lot of money betting on it happening. I am sure you are all aware of people like Michael Burry, made famous from the film The Big Short, where he predicted the global financial crisis. Well, that might have worked out well one time and got him a lot of attention, but for every right call, there are literally thousands of wrong ones that get made. He has made plenty of wrong calls since then. Anyway, here's another example that doesn't get covered much in the mainstream media. There is a professional fund manager called John Hussman who set up his own investing fund after a career as an academic. He is as smart as they come, literally a genius on paper. He has got a PhD in economics from Stanford University, and he was professor of economics and international finance at the University of Michigan. Now, John correctly predicted a couple of massive events. Just like Michael Burry, he predicted the global financial crash. But on top of that, he also saw the dot-com bubble coming as well. After nailing these events, he obviously got a lot of attention and grew his investment fund to billions of dollars. People assumed that as he predicted something happening, he must therefore know the future, and the money came flooding in. This was obviously a terrible time for investors overall. Two major crashes not too far away from each other, and many people would have been underwater buying pretty much anything. It is no surprise that people were looking for alternatives and to professionals who claimed they could make them money. By Downsetting, John had amassed almost $10 billion for investors. And during the global financial crisis, he performed well. Although still losing money during this time, his fund was nowhere near as low as the other managers, as his fund was set up to bet against the market. Now, what comes next for John should be a lesson for all of us that will lead us nicely to getting a proper answer. As many of you know, after the global financial crisis, the stock market had pretty much an uninterrupted bull market all the way until the pandemic. The SP 500 went up with an average compounded return of more than 4% a year. So, anyone who bet against the market during this time was not going to have a very nice time. With all of his expertise and qualifications, did John foresee that the crash was over and the bull market was about to begin? No, in fact, he doubled down and kept betting against the market, insisting that everything was overpriced and the market was completely irrational. Over the last years, his fund, which now has a few $100 million inside of it, has returned a negative 20% a year. So his investors have not only lost money, but have been paying extremely high fees to be part of his supposed incredible market insights. And to this day, he is still convinced that a crash is happening. Hopefully you see the point I wanted to make here. There is nobody that can predict when a stock market crash can happen, but there are and will always be people who call for a crash every single day. Just because they get their timing right once doesn't excuse them every single time they were wrong. You cannot predict the future moves of the stock market regardless of how intelligent you are or what qualifications you have. So where does that leave us then? Well, first off, let me just reiterate this point again, that nobody can predict the market. Absolutely nobody knows what will happen in the future, and that is part of the game of investing. And in fact, that is why investors even receive returns in the first place. We are putting our money into shares and other assets with the hope that they will rise in value over the long term with absolutely no guarantees whatsoever. The alternatives like saving money, which have a lot more certainty, give us a lot lower returns. Basically, with no risk comes no reward. When we invest, we need to expect that the prices of our investments are going to change every single day. In the worst-case scenario, the stock market can have a terrible crash and the value of our investments can go down a lot, or sometimes they just go nowhere for months and even years while you watch your cash rot from inflation. That is just part of investing, I am afraid, and if you take on too much risk, like buying shares in a company that your mate told you to buy at the pub, you can even lose everything. Now, I don't want to get too negative about things because there are plenty of reasons why investing is an amazing thing to do. I have been sharing all of my knowledge on YouTube for almost 2 years now, and as many of you will know, I share exactly what I invest in. I even started a brand new stocks and shares ISA this month, even with everything going on in the world. But you know what? This is a perfect example of putting my own money exactly where my mouth is. I think it is worth remembering that there will always be a reason to not start investing or to stop investing. There is always going to be something going on in the world, or some voice in the corner calling for the worst thing to happen. As a human, you are naturally going to want to protect what you have and pay a lot more attention to those kinds of people. Personally, I think the real damage from a stock market crash is not necessarily from the crash itself, it is from how we react to the event. Just think about this for a moment. If you were able to go back to Ijo Wudin and get £1,000 into the SP Wudinin, by today you would have Shuwudian Wuyuni Lion pounds. Now, that is without inflation taken into account, but even if you did do that, you would end up with massive purchasing power. Anyway, with that all said, how do you make sure to get through a stock market crash and come out the other end, not just surviving but thriving? For me, this comes down to a few key principles, and these are the steps I would take. Firstly, step 1. When I invest now, I am doing it with a plan. I didn't necessarily have this when I first started, as I really had no idea what I was doing and was just chasing green numbers. But as the years went on, I now have a clear vision of what I want to achieve. For me, it is all about financial freedom, so I want to invest my money as efficiently as possible in low-cost funds for you. This could be a goal of retiring earlier, or it could be saving for a house one day. Either way, you need to have some kind of plan. Otherwise, you are just throwing money at a screen for no reason at all, and when you do something without a plan, you can easily get knocked off course when the red candles start appearing. Now, in that plan, I am sure you said to yourself that you were going to be a long-term investor and keep investing no matter what. Well, if a crash does happen, you need to go back to that plan and stick with it. Otherwise, it was never a plan. If it helps, run the scenario in your head. Ask yourself how you would feel if your investments drop by such a percent or even such a percent over the space of a few weeks. It is never going to feel great, but you have to truly ask yourself if you can get through this without hitting the sell button. Secondly, invest like you mean it. When I say this, I mean getting yourself in the best possible position before you ever buy a single share. You have got to have all the basics covered and have a strong foundation like a brick house. For me, that means things like only investing money that you can afford to keep away for at least 5 to 10 years. It means making sure that any high-interest debts like credit cards or payday loans are paid off. And it also means making sure you have an emergency fund of at least 6 months of expenses. Everything has to be aligned with making sure you do not need to sell your investments if the worst was to happen, because you cannot lose money as an investor if you do not sell. Only those people who sell at the bottom of the market end up losing money. Those people who hold on and stick to the plan get to reap the rewards when the market inevitably recovers. This point also includes making sure you invest in a way that matches your own level of risk and being well diversified. If you only choose a handful of hype stocks and they end up working out badly, there is very little you can do. Try to find something that works for you. And this is something only you can decide after doing your own research. For me, I like to invest using low-cost index funds like VU or VUSA for the majority of my investing. So basically, all my money gets spread amongst all the world's biggest companies. And I don't worry about individual earnings calls. I just focus on getting more money in every month no matter what, and making sure that I use tax-advantaged accounts.